Welcome to Accounting for Business Decision A, Financial Statements. The objective of financial statements is to provide information about the financial position, performance, and changes in financial position of enterprise. It's useful to a wide range of users in making economical decisions. For example, managers, shareholders, financial institutions, or customers. The four financial statements: statement of comprehensive income, statement of financial position, statement of change in equity, and statement of cash flow. The statement of comprehensive income, also called revenue statement, basic form of which is revenue minus expense equal net profit or loss, reports the company income, expense, and net profit or loss for specific period. Income statement is prepared based on accrual concept whereby income and expense are recognized when they incur. The revenues is increase in resources resulting from selling goods and services, and expenses decrease in resources resulting from sales of goods or services. The statement of financial position, also called balance sheet, form of which is asset equal liability plus shareholders' equity, shows company asset, liabilities, and equity at a specific point in time. The asset is something business owns or controls, for example, cash, inventory, plants, or machinery. Liability is something business owes to someone else, bank loans, for example. The equity is what business owes to the owners. This represents the amount of capital that remains in business after its assets are used to pay off its outstanding liabilities. Equity therefore represents the difference between assets and liabilities. The statement of change of equity, for which formula is beginning retaining earnings plus minus net profit or loss minus dividends equal ending and returning earnings, shows change in company retaining earnings, for example, contributed capital and paid dividends over a specific period of time. The last statement is statement of cash flow, formula for which is cash flow from operation activities plus minus investing activities plus minus financial activities equal net increase in cash. Basically, it shows movement of cash during a specific period of time in operating, investing in financial activities of an entity. Well, source and use of cash, basically. The operating activities present the cash generated or used in the ordinary activities of entity, for example, buying supplies or sale of products. Investing activity presents the cash used by company to purchase revenue-generated assets that needed for operations, for example, office building. The financial activity presents the cash flow realized by acquiring finance, such as by issuing shares. It also includes the related cost of finance, example, payment of dividends and interest. So we just looked at four financial statements, so now let's see how these statements link between each other. We start with the statement of comprehensive income, formula for which is revenue minus expense equal net profit or loss. The figure of net profit or loss goes into statement of change in equity as beginning returning earnings. As we previously discussed, the change of equity formula, beginning returning earnings plus profit or loss minus dividends equal ending returning earnings. The ending return earnings goes to the statement of financial position as a balance of returning earnings. Finally, ending balance of cash flow statement should agree with the balance in cash or statement of financial position. Thank you.
Created using Powtoon.